As traders, we are in constant search of the pattern that would make sense of the structure that the market is presenting to us. As price action traders, we are not relying on indicators, we're relying on candlestick formations as they are printing on the chart. For that reason, we need to correctly identify the structure, and we need to identify where the key entry point is going to be located. Key entry point is a place on the chart where high probability setup appears, and that's the place where buying and selling pressure is accumulating. As traders, we are constantly making the decision whether we're going to follow the bigger pattern or we're going to stick to the short-term trend lines, short-term patterns. And today we can see that we started with the bullish structure, bullish move up, but this wasn't particularly easy uptrend to find because the structure is looking like a trading range and it's very spiky, and this is not just clean uptrend that would be easily identified, but we can see that the price is pointing higher. We are making series of higher highs, higher lows, and the exponential moving average supportive indicator only is pointing up. So what do we do when we are struggling to properly identify the bigger pattern? First, we're going to stick to the short-term patterns. Short-term trend lines will always keep you on the right side of the market. If you follow the trend line rule on a very micro level, you can never go wrong. But if you want to find and correctly identify the bigger pattern, and you're struggling to find it on your main chart, what do we do? Well, we're going to use additional time frame and we're going to scale up higher, and we're currently looking at 10,000 tick chart. This is the 10,000 tick chart for S&P 500 E-mini futures, and we can see that the price started with the steep and tight bullish channel, which eventually price broke the upper trend channel line and created an overshoot. This right here is overshoot, you guys can see, because price normally should be oscillating in between the channel lines, but here price is breaking the other side, the upper trend channel line, and this is very unnatural activity, and this is overbought territory. Take a look how far away price is getting from exponential moving average. EMA acts as a magnet and price will eventually pull back to the exponential moving average. Overshoot will a lot of times generate strong momentum to break the trend line or either straight up reverse. Because according to trend line rules, when there is a break of a trend line, traders expect the new extreme to be formed, but overshoot is so strong that we may not even get an attempt for new extreme, let alone new extreme. Overshoot can be so strong that we can straight up reverse the market, and this is exactly what happened today. So when I'm looking at my main chart, 2000 tick chart, and I struggle to find the bigger pattern, I take a look at the 10,000 tick chart and I can see that there's a nice bullish uptrend, but we have a massive overshoot and we are trading lower. And you guys can see how textbook the pattern looks on the 10,000 tick chart. And I used a similar approach yesterday when you guys can take a look. Price is working lower. We have a very structure working lower, but this downtrend was not easy to find, but we are making constantly series of lower highs and lower lows. So we can either stick to the short-term trend lines or we can try to locate the bigger pattern. And this is what yesterday looked like. You guys can see that the downtrend was very easy to find, followed by a two-legged pullback correction. After break, price tends to create new extreme and two legs to new extreme. So this is how I used 10,000 tick chart yesterday, and this is how I use 10,000 tick chart today to identify the uptrend and to identify the overshoot and identify the downtrend. What is really interesting from price action perspective when it comes to this last move is that this is a depletion move. Every time you see a strong trend bars at the very last stages of the move, far away from exponential moving average, that a lot of times indicate exhaustion and depletion. And you guys can see price was strongly spiking higher and higher, and instead of price correcting, there were three additional big gigantic bullish bars at the very end of the move, and followed by a big bearish bar. This is a depletion move because this is not long-term sustainable. Price cannot continue working higher steep like that. And when you combine it with the overshoot and the big trend bars at the very end of the trend, this tells you that the probably trend is depleting and it's time for a larger correction. So when you have an overshoot, you expect larger correction. So for that reason, as price is right now working sideways in this trading range, you're basically not taking this uptrend too much into consideration, because with the overshoot like that, you're just basically sticking to short-term patterns and you're letting the correction play out. Even though it's counterintuitive that the trend was up, the bias is right now at least temporarily bearish because the overshoot can generate strong momentum. And you guys can see this trading range is just a sideways movement. EMA is getting flat, it's in the middle of these bars, so this is a no trade zone. You want to wait for price to break out of this congestion and out of this mess. Now as the price is breaking lower, normally we want to fade the breakout out of congestion, but here is a little bit nuanced. We have the overshoot, and this will really, if you take a look at the 10,000 tick chart, the overshoot is really big, and that tells you that you may not probably get even attempt to create new extreme. So for that reason, you're just sticking to short-term trend lines and you're not fading this breakout, because we can get a straight up reversal. And as the price is pushing lower and lower, it's starting to get clear that there is truly no buyer's momentum and we're truly going to reverse and continue working lower. So as the price is pushing right now lower and you're all the way down here, which you basically retraced 50% of the move, this is a lot of times indication that the new trend is starting and you may not even get a continuation of the previous trend. So right now you're focusing on the short-term downtrend that is working lower like that. If you combine it with the 10,000 tick chart, you can see that there is a clear downtrend working lower, and EMA really didn't put any support here for price to continue working higher, almost like it's not even there, and price reverse working lower. Since we are right now in downtrend, the high probability setup where we want to take trades and where we want to sell is a second entry short, two-legged pullback, or failed second entry long. But we didn't really get too many opportunities today to sell. I really didn't see that many setups because we have a downtrend working lower. We have a break. So once you have a break for the downtrend, you would be expecting for price to create a two-legged pullback at the key entry point. And key entry point is the exponential moving average because the trend line right now broke. But there was a first entry short, and first entry short created a new low. So we have to reset the count here because this low is lower than this one. So if I reset the count here again, I get a first entry short and I expect a little pullback to give me a lower high or that would create a second entry short. But once again, price never pulled back and instantly created a new extreme. Now, when you see this and you see price continuing lower and lower, you can even start looking for a little bit wider patterns because price keeps really pushing lower. Because after you have a break, new extreme, you'd be expecting for price to push above EMA. But we can see that the price really couldn't push above EMA and price instead reversed back down. So this showed us a continuation of a downtrend. So there can be found a bigger pattern like this. And this is the pattern that I had today when I was looking at the chart. So right now EMA is still pointing down. Price is failing to break above, and this is a strong indication. Take a look at every single time price tried to break higher, EMA held price and rejected it. So this isn't right now. Two key entry points are holding. This trend line got confirmed and you have a new low form. So we're still looking for second entry short or failed second entry long. You have a new low right here and we have a first entry short, push above EMA, second entry short. When we are watching this first entry short, we are already anticipating that there may be a high probability setup form, there may be a second entry short form. When I was watching this, if this bearish bar reversed straight lower, I would have probably gone short here. But instead, price pushed above EMA, which already indicated something different. If I'm going to go short, EMA is supposed to reject price and indicate bearish momentum. But it didn't happen here. Price pushed above, and which confirmed the short-term uptrend. If price wouldn't push above, there would be no short-term uptrend. We would reverse down and it would be great sell. But with this push right here, price is confirming the uptrend and I need to follow the short-term trend line rules as well. So I get a second entry short here, but we first push above EMA and then price still is inside of this channel, so I cannot go short here. But take a look what happened. There's the first entry short, second entry short failure, and everybody who went short too early got stopped out, and everybody who's trying to go long too early is getting trapped again because price ticked higher and instantly reversed down. This is a double trap because it's still closed below EMA, and double trap is not a third entry that is just anywhere on the chart. It still needs to be part of the overall trend and it still needs to be with below EMA in this particular instance because we're talking about downtrend. So everybody who went short too early got trapped, and everybody who went long too early because the structure is bearish. We don't have a break and a new low for the bigger downtrend. It's just the first break. So no longs just yet. So this is a nice double trap. But you guys can see that we're right now going sideways. We have 1, 2, 3, 4, 5, 6, 7, 8 bars going sideways. EMA is getting in the middle of these bars. And overall, this is getting a little bit stacked. I didn't take this trade myself. It is a first decent trade for the day, given the fact that it took one tick higher and still reversed down. Big bearish bar, you get a micro break, new extreme form. And since this is the first break of this downtrend, according to trendline rules, you expect new low to be expected and a perfect price action. Price keeps pushing lower, and take a look what you have. You have a first leg to a new low, you copy it, you get a second measured leg to a new low, but price keeps creating another push down and another push down. So this probably tells you that there may be a bigger pattern in play, because once you get a break and a new low, you expect for price to correct or straight up reverse. But we keep pushing lower and we keep pushing lower, and every single time you see so many new legs to a new extreme, there's probably a bigger pattern. But what's more important is if you zoom out like that, if you know from the previous videos, every single time you need to identify the lows for the day and highs for the day. And when you see a strong V-shaped reversal like that, strong move up and instant reversal, and by the time you're already down here and the downtrend is strong, you know that the target for the day is the low of the day key level. So what I'm going to do, I'm going to mark the key level for the day, and this is the target, and this is where I expect for price to go, because this is very important place on the chart key level, and a lot of times price will keep it as a target. And you guys can see price eventually made its way there. We consolidated around the important area, and price eventually broke lower. So this is how you identify the key levels on the chart, and they are very important: lows for the days and highs for the days. Always just put your line there so you can visibly see it, and every single time you see a trend working in the direction you expect for price to reach the key level low of the day. So once the price is pushing lower and lower, there is a bigger pattern in play. So I'm just going to quickly delete this, and I'm going to mark this pattern right here. One swing right here at the start, second swing right here, and the third swing confirmed it. So that's enough confirmation for the bigger pattern. And if you can properly identify the pattern, because there are multiple, you eventually keep pushing lower and lower, so there is even a flatter channel. You don't have to worry about the channel. Only thing you worry about, you accept the bearish bias and you focus on entries at the exponential moving average. You just know in back of your mind there's probably a bigger pattern, because this is a 100-point move down. If I'm going to measure this, you guys can see 101.75. This is a 100-point downtrend. So when I see a strong trend like this, I just accept the bearish bias. I just look for shorts. I look at the entries at the EMA, and I'm not even thinking about buying. Even though we have a break at a new low, I'm not even thinking about reversals. All I'm thinking about is I'm letting the bullish corrections play out. And when we have another push below EMA, that's when I'm looking to resume the shorts. Okay, because 100-point move down is just not going to reverse on a dime like that, even if you're at the low of the day, because a lot of times price will just hover around the low of the day and eventually break lower, because 100-point move down is a substantial downtrend. So as the price is right now working sideways, you guys can see we have a bottoming pattern. EMA is getting flat, lows are static, and we're just swinging up and down, up and down. If there was some nice second entry short right here, I would have liked the entry. You get a first entry short, second entry short right here, but it's close to these lows and it's way too stacked. 1, 2, 3, 4, 5, 6, 7 bars going stacked. You cannot go short right here. Then you get only a first entry short right here, and you get a little bit of a failed breakout out of this congestion, and you are at the key entry point. So you have a confluence of trend line as a key entry point and a high probability setup, which is a failed breakout out of the congestion. Nice bearish reversal pin bar, quick easy scalp. Personally, I resetted the count here, so I treat it as a first entry, but this low is technically a little bit lower than this. So this is a first entry short, pullback, second entry short as well. A great entry for a quick scalp. Key entry point is holding price and is a failed breakout out of the congestion. But you guys can see, price created a first leg, pullback, second leg up. So this is a two-legged pullback, and we can see that the uptrend played out with the break and the new low. So that tells us that it is safe for us to sell. And we're going to sell because the overall bias is still bearish. Price is still creating series of lower highs and lower lows. And this is now the first break for the bigger pattern, and we expect for price to create a new extreme. So the way we identify that it is safe to sell is by the fact that we have a two-legged pullback up, because market likes to move in pairs of twos, and the uptrend played out with the break at a new extreme. That tells us that it's safe to sell, but we don't want to pick top. Notice how I didn't mark, because you never know how many pushes you're going to make higher. You can go short right here, and you would have just gotten stopped out just to see it go exactly where you want to go. When you see this and you anticipate shorts, but you're in the middle of nowhere, basically you have no key entry point, the confirmation setup and the safe entry is a lower high, because you don't want to pick top. You want to wait for price to trap a few more buyers, and you guys can see price ticked higher, instantly reversed down. So this was a great lower high confirmation of this break, and it's a two-legged pullback up, and we expect for price to create a new extreme. A lot of times lower high is a great confirmation when you expect to get the new extreme if it pushes below EMA. Here it was a little bit above EMA, but that's not a problem because it's such a great bearish bar indicating a lot of momentum. I tried to enter this trade right here. Unfortunately, my limit order wasn't filled, and I even moved it one tick far away as a stop order entry. Price never looked back, it instantly shut up. So this was a great entry, high probability setup, probably one of the better setups today, because there were really not that many setups today. Market continue pushing lower, we have a new high form. So if there is a lower high and we keep pushing below EMA, was going to be a high probability setup. Failed second entry long, keeping it simple. Price action is simple, new high, first entry long, pullback, second entry long, failure. My first trade for the day, I took this trade right here. I actually took it based on 2500 tick chart. I took it, you can say, on an engulfing entry. Once price ticked higher, it's a little reverse down. As I saw bar finishing on 2500 tick chart, that's when I sold, and it was a quick easy scalp. By the time you see this bearish bar form, you cannot go short at these very lows right here after such a big bearish bar form, because the scalp was technically made below the engulfing bar, below this doji. Okay, so this is the engulfing entry. It ticks one tick higher and instantly reverses down. This is the momentum and scalp must wait. You cannot go short after big bearish bar at the very low of the move. The same thing happened right here. This is a gorgeous second entry short, but you have almost no room to these lows, and this is a big bearish bar. When you see a big bar like that at the end of the move, that a lot of times can be a trap and can be a depletion, and you need to make sure you have enough room for a scalp. I marked this entry because this entry was perfect on a June contract. We have a March contract and we're going to roll on Monday. We're going to get to this. But this was the failed second entry long right here. You expect for price to create new extreme following the price action. This is a textbook price action setup, and you guys can see what happened here. Sometimes when the failed second entry long or failed second entry short, but when the failure in general doesn't really have two clear visible legs, a lot of times there is additional pullback, and you guys can see there's a new high first entry long, second entry long right here, but probably not that many people are going to go short directly at these lows. So there was additional pullback, much cleaner entry, and this is still part, we can consider this, of this failed second entry long. But since this was a technical second entry long failure that failed, I don't think you want to go short here. I was waiting for a second entry short here, but there was no second entry short, and price just continued pushing lower. But you guys can see break, new extreme form, but the target is still low of the day, and this is by this time this is an 80 or 90 point down move. So you're not looking buying the bottom, you're just expecting for price to correct, and then you're expecting to short. So as the price is correcting, you have a new low, first entry short, second entry short right here at the key entry point, breakout pullback area. Price broke and tested the previous key level, the breakout area. However, uptrend is in place, so you cannot go short just yet. Once again, I was looking for a lower high to give me at least a 10 for new extreme. There was no tick higher, no setup. First entry short, no setup, new low. First entry short, second entry short, but this second entry short pushed above EMA, closed above EMA, and this uptrend is once again in play. So you cannot break the rules. You cannot cherry pick. You have a set of rules that you follow, and if you want to be consistently profitable long term, you just cannot cherry pick. So you're just sitting patiently here. Today, not that many setups today. You just have to sit here and be patient. Finally, market created the low of the day touch, the target was filled, and you guys can see market is pushing higher. You have a new low, first entry short pullback, second entry short failure. If this was a little bit of a better signal bar, this could have been a quick, easy, decent scalp. But personally, when I see a 100-point move down like that, and I see how EMA is rejecting price every single time, take a look. Price pushed above EMA for the short period of time, and it instantly reversed back down. This is telling you something, that EMA keeps holding price. So for that reason, when I'm looking at this and I look how EMA is getting flat and we are oscillating up and down, this is a trading range, and I just expect for price in this correction play out, and I expect for shorts to resume. And we have a little repeat pattern of this pattern right here, because we have an uptrend working higher, break, new extreme. So this tells us the buyers are no longer in control and we are safe to sell. We have a first leg, pullback, second leg, just like we had right here, first leg, pullback, second leg. But just like here, we just don't want to pick top. Even though it would have worked picking top right here, quick easy scalp, and picking top right here, you're better off to wait for price to confirm the push below EMA and give you a lower high. And we never got a lower high right here. This would have been a great lower high confirmation of this failed breakout below EMA. There was no trigger lower, and price created new low. New low was formed, first entry short, second entry short right here, new high, first entry long pullback, second entry long failure at the exponential moving average. And this is the June contract, and this is how great the setup looked on a June contract. You guys can see uptrend break, new high, two-legged pullback to key entry point, first entry short, second entry short, first entry long, second entry long failure, great bullish bar, a lot of room to these lows on a June contract. And this is the extremely high probability setup. This is what this strategy is about, and these trades are extremely reliable. So if you just keep waiting and sitting on your hands, you will get rewarded with a good setup at the end of the day. Unfortunately, on this chart right here, it still would have made a small scalp, but you just cannot go short directly into this micro double bottom, into key level for the day like this. You need to make sure you have more room. The bar is way too big, and every single time you see big bar at the end of the move, that a lot of times can be a trap and depletion. Take a look at this big bearish bar at the end of the move right here. It trapped everybody. Big bar at the very lows, it trapped everybody. So when you see big bars like that at the very end, this is a difference, because this is a big bar at the highs. This big bar form at the top of the trading range. So we have room here, but these big bars are forming directly at the lows of this entire move. The same thing to the upside. Okay, if you see big bullish bars at the very last stages of the trend where there is almost no room to previous swing, you have to be careful. That's how a lot of times beginner traders, they get trapped, because they a lot of times trade momentum candles. They only care about how big and strong the candle is, and they're not taking into consideration the context. Eventually market broke lower, because if you zoom out, you constantly need to zoom out, you remind yourself how strong this downtrend was. The bulls have almost no control here, and even though you have a break and new low, there's probably even a flatter pattern being present. I guess we can find a different channels like that. You don't need to find it. Only thing you're focusing is the pattern and is the bias, and you're just trying to sell. Market created, and it's already way too late. And not that many setups. It is a rollover date, so it is pretty typical that during rollovers like this, both contracts are slow. But on the Monday, we're going to roll over to June, and this was the March contract. I hope this video was helpful, educational. I hope you had a great trading week, and I'm gonna see you guys in the next one. So take care, everybody.